My name is Gary Mack, and welcome to On Point with Your Legal System. This show is designed to give you an understanding or an outline of a variety of fields of legal concerns and problems. Today's show is on starting a small business. The American dream is owning your own business, but it can be the American nightmare without good legal advice. Our speaker today is Dave Devendorf of the Davidson, Stager, Adair & Hill law firm here in Port Huron. Let's listen to Dave give us an outline of the various forms of business entities.
The topic is forming a small business, and it can be a very boring topic. Try not to make it academic, try to make it practical. But the best way for you to get anything out of as much as 2 hours in this program is to ask questions. And rather than save questions for the end, when you're all bored to death and we've kicked this topic over more than it should be, I want to encourage you to ask questions as we go through. And the format for the evening and what I am going to do is compare for you in a lot of different respects the 4 ways of doing business in Michigan. One is a corporation, one is a partnership, another is a limited partnership, and there's a 4th way of doing business, which is an offshoot of a corporation, an S corporation. And I think I want to put those on the board because I'm going to refer to them from time to time. As we go through this and talk about them, we're going to compare these 4 types of entities, corporation, partnership, limited partnership, and S corporation, in a couple of different ways. And one is going to be the state law treatment, the treatment under state law of these entities by creditors, which would be something near and dear to anyone's heart who's thinking about starting a small business in Michigan. And the second way is to talk about the tax treatment of these kinds of entities, because the tax treatment of each entity is very, very different. The overview, and the point I want to make, is that the ideal that it seems that the tax law is working toward is to make the tax treatment of these entities neutral, or the tax decision of which kind of entity to select make that decision a tax-neutral decision. They're not there yet. They're trying to head in that direction, but I think you'll see as we go through this that the taxes are becoming of diminishing importance in deciding how to do business in Michigan. An overview in doing business in Michigan, one way to do business is in the form of a corporation. Main advantage of a corporation is that the liability of the business owners is limited to the assets that they put into the corporation, as a general rule. As with any general rules, there are several exceptions. There are lots of exceptions. We'll talk about those in a little bit. The one effect of forming a corporation is that when you form a corporation, you're forming a new legal entity, and that new legal entity becomes a taxpayer with its own tax rate, its own sets of tax rate schedule, its own sets of deductions, its own sets of exemptions, its own sets of tax credits. It's a separate taxable entity. A partnership, on the other hand, does not protect one from liabilities. Every partner is responsible for all of the partnership's debts, not just for that partner's proportionate share of the partnership's debts. And in that respect, it's in marked contrast to a corporation. Partnerships also taxed very differently from a corporation because it's not a taxable entity. It's what we call a pass-through entity, and we'll talk about that in a few minutes as well. The last 2, the limited partnership and the S corporation, are both offshoots of the first 2. Limited partnership, of course, is an offshoot or a form of partnership, and it's used often with real estate investments and real estate businesses. It gives you it can give a limited partner a fashion of limited liability, but like a partnership, it's a pass-through entity for tax purposes. And then the last way to do business in Michigan, as a general rule, is as an S corporation. That's formed under state law, just like a corporation is. The same protection from the liabilities of two creditors, but the tax treatment is very, very different. It's for business purposes, you run it like a corporation. It has all the benefits of a corporation. For tax purposes, it's treated basically like a corporation. So, and we'll talk about that a little bit more in the next few minutes. But that's the overview of these different kinds of entities. When I counsel clients about how to form a business, I try to focus their attention not so much on the tax effects, which historically, and I think we Americans are trained to try to think about taxes all the time, and if we're not careful, we can let tax considerations govern our decision making, when in fact the primary consideration in forming a business, I think, particularly in Michigan, and particularly, I was going to say in the 1980s, but even more so in the 1990s, is liability. To what extent are you, the business owner, or the partner, or the part business owner, putting your personal assets at risk by entering into this business? So the primary thrust, to my way of thinking, is to limit your liability as much as possible. Lots of different kinds of liabilities. And in this respect, I'm going to talk first about corporations. When a corporation is formed, as a general rule, the liability of the partner should be limited to the assets that are placed in the corporation. If you turn over your real estate, say a factory, a garage, rental dwellings, whatever you put into that corporation, if there are creditors of the corporation, those assets are subject to the claims of those creditors. Many times, if it's a retail business, those are contractual claims. If you've got suppliers who supply inventory on 30, 60, 90-day terms, the retail business gets the inventory in and doesn't pay for 30, 60, or 90 days. Those are contractual liabilities that the corporation is responsible for. Ordinarily, there's no liability, personal liability on the part of the shareholders for the corporation's debts to those suppliers. If it's a manufacturing firm, the best example I can think of is a client I have that manufactures small parts that get assembled into large machinery in automobile factories. And this is in the form of products liability that you read about in the newspaper. He manufactures a product, he puts it into the machine, and then an employee working on the machine for the automobile industry is injured. In this case, it was a serious injury, a lost hand. The lawsuit that's filed against the corporate contractor, in this case he was incorporated, is filed against the corporation. There's no cause for action against the individual on the tort theory ordinarily. There might be some creative lawyers who might come up with theories, but in a general sense, the responsibility is that of the corporation, and the liability is limited to the assets of his particular corporation. The slip and fall cases, when you have a retail business in downtown Port Huron and someone slips and falls on the ice in front of the building. Generally speaking, if your business is incorporated, that protects you protects the owner. It doesn't protect the business. The business assets, the corporation's assets, are subject to the claims of the creditors, but it protects the business owner from the claims of those creditors. Some exceptions to those rules, and these are common exceptions. Even in the case of a corporation, the shareholder employee, or the shareholder of the corporation, is not immune from certain kinds of liabilities. The most common one is, particularly with a new business. The new business is formed, the corporation is formed. Some of the assets, oftentimes from the sole proprietorship or the former partnership, are put into the new corporation, and it's all set up as a corporation. And the next stop on the way to unlocking the door and going into business is at the bank to get a line of credit or some kind of bank financing. If they've heard a nice speech from their lawyer about limited liability that they enjoy with corporations, they're going to learn something about personal guarantees when they stop and see the banker, because the banker's going to say, sure, we'll be happy to lend your newly formed corporation $10,000, $20,000, $30,000, $50,000, whatever amount is needed, assuming that they're credit worthy, they are not otherwise bad credit risks. In the promissory note, the bank will draft the promissory note so that it can be made by the corporation. But what the banker, no doubt, will also ask for is for a personal guarantee of the shareholders, because the bankers weren't born yesterday, and they know if the corporation, if the business fails, they want to have recourse not only against the corporation and its assets, for the very reason we're discussing, limited liability, but they also want to have recourse against the shareholders of the corporation. And the banker, no doubt, will require a personal guarantee of that loan. So I say that's a major exception to the general rule of limited liability, but it's an exception that a shareholder can choose to make. That's a contract. The shareholder can choose and decide, excuse me, whether to guarantee that bank loan personally. A second exception, pardon me, second exception that's not quite so voluntary is one that's also unfortunately quite common, and we see it happening more often particularly in the state of Michigan during a down economy, and that is payroll taxes. It seems like when things get tough with a business, about the first thing that a business owner does when cash gets short is withhold money from the employees' paychecks, and then negligently or intentionally fails to pay it over to the Internal Revenue Service. And if you think IRS agents don't have any sense of humor in general, and many times you're right, you ought to deal with them when someone hasn't paid over the payroll taxes that are withheld from wages. You think about it from the IRS agent standpoint, that's money that the employee gets to take credit for on his own income tax return because the employer has withheld it from his wages, and he gets credit for it, but if it hasn't been turned over to the Internal Revenue Service, they don't get the money, even though the employee gets credit for it. It's considered a trust fund, and any responsible person, an officer or director of a corporation, who knowingly, not intentionally, but just knowingly withholds it and fails to pay it over, is personally responsible for the repayment of those amounts. And I know from personal experience with clients that they just don't mess around with that. In fact, it's to the point that the Attorney General's Office and the Justice Department, the United States Attorney General's Office, doesn't even delegate the authority to settle these cases to the local U.S. attorneys in major cities like Detroit, San Francisco, New York, Cleveland, Cincinnati. Rather, they keep control of these payroll tax cases in Washington, and when they run into a local lawyer who's willing to try to contest the responsibility of the officer whom they have assessed for this tax and take it to court, they send in their lawyers from Washington to try these cases. And that often gets the attention of a small town lawyer in Port Huron when you've got a tax case going to court in federal court, and you don't run into the United States Attorney from Detroit, but rather they fly somebody in from Washington to try the case against you. It has an intimidating effect, and I think it's intended to be that way. Major exception to protection from personal responsibility, and that's payroll taxes. State of Michigan followed suit with sales taxes. They have the same rule with sales taxes and some of the other taxes, where there is personal liability if the business owner fails to pay the sales taxes over to the government. There is personal liability on the part of the responsible officer. I'm talking about officers of corporations now. In small businesses, in most cases, the officer of the corporation is one of the shareholders as well. And we'll talk about that again a little bit later, to the extent you're interested in knowing about how a corporation works. In large corporations, that's not necessarily true, but in small corporations, in small businesses, the officers are usually many of the same people as the shareholders. Another exception to the rule is if an officer or a director commits fraud. Forming a corporation in good faith is not carte blanche to freedom to run a business in a fraudulent manner and be immune from the claims of creditors. If that officer, shareholder has done something intentionally wrong and misrepresented something or obtained property or supplies by by misrepresentation, that person can be held personally responsible for that, and that probably goes without saying. A final way that a shareholder, even though a corporation is formed in good faith, the shareholder can be held responsible for personally for the corporation's debts, is if they form a corporation and do not operate it as a corporation. It's commonly referred to as piercing the corporate veil. And if you form a corporation, file your papers in Lansing, and then forget about it. You don't let the public know that you're doing business as a corporation. The name of your business doesn't, on the sign and on the letterhead and on the invoices and on advertising, very importantly advertising, if the name does not contain the word company, corporation, or incorporated, or limited, L-I-M-I-T-E-D, or some abbreviation of those four words, then the public is not put on notice that the business is in fact a corporation and being conducted as a corporation. And the theory is that the public then has the right to assume that they're doing business with a sole proprietorship or a partnership whose personal assets stand behind the business. And so even if a corporation is formed technically in the proper manner, but is not operated in the proper manner, that shareholder can be held personally responsible for the corporation's debt if the corporation fails. So that's a background on the main advantage of doing business as a corporation, limited liability. There are exceptions, but as a general rule, there are not exceptions that are not the fault one way or the other of the shareholder. If it's formed right and it's operated right and they do things properly, they are assured that they will not be held responsible for the corporation's debts. That is true also of S corporations. Keep in mind that an S corporation is, there's no distinction between a corporation and an S corporation as far as Michigan law is concerned and liability to creditors are concerned. The S corporation is simply different under federal tax law. They are both the same kind of entities. Thank you. Hard to imagine that a lawyer could be that thoughtful, isn't it? We don't want word to get around that Gary's a nice guy. It's the worst thing that can happen to somebody who practices law. Turning to the couple of tax factors with a corporation, and you're now imagining that you're sitting down with someone who's advising you and helping you make some decisions on how to form your business. And after we talk, your advisor has talked to you about liabilities and the limitations on liabilities and the need to limit your liabilities. You start talking about taxes now. And it sounds like a corporation is a good idea to you because of the limitation of personal liability. Now, once you've made that determination, and if that's important to you, then we start talking about taxes. The interesting thing about corporations, and this will never change, the rates may change, but it seems like the structure doesn't, and that is when you form a corporation, you're forming a separate taxable entity. And so now you're dealing with two separate levels of tax. You're dealing with the income that's earned by the corporation, which gets taxed at the corporate level, and it has income and deductions at the corporate level, and you're also then talking about the shareholder, who of course has income and deductions at the shareholder level. Two separate sets of tax rates and tax laws that have to be dealt with. As an example, and to illustrate the problems you deal with when you have a regular corporation, when I say a regular corporation, I mean this kind of a corporation, not an S corporation, is that when the corporation earns money, it's taxed at the corporate level. If the corporation earns a profit and then pays a dividend to the shareholder, that dividend, which represents money, income that's already been taxed once at the corporate level, gets taxed again when the shareholder puts the dividend in his pocket. So the strategy and the planning, the tax planning that goes into business planning is to try to minimize the effect of that double taxation problem or avoid it to the extent that you can and within the limits of the law. And that becomes a problem or a drawback in taking advantage of the limited liability that is the advantage of corporations, disadvantage that you've got two levels of taxation. The only way to understand the strategy behind it and the planning is to look at what we lawyers and accountants did up until 1986, and then talk a little bit about what's happened after 1986, since 1986, and then tell you what the conclusion is right now as of 1991. Prior to 1986, for a long time, the common advice and the common strategy was to set up a corporation and in small businesses try to pay out as much of the profit as the shareholders needed in some manner that was deductible to the corporation. Idea was to only pay tax on this money once if you could do it, not twice, since you have a double tax rate system. and that meant the corporation would receive income and try to pay, make payments to those shareholders in the form of really one of 3 or 4 different ways. Compensation, salary, because that's deductible to the corporation. A bonus, if it's justified by profit, because that would be deductible to the corporation. Rent, if the shareholder owned property that didn't have to be put into the corporation, thereby exposing it to the claims of the corporation's creditors, the shareholder would keep that asset out and rent it to the corporation. Then if the corporation had profit, the corporation would pay that shareholder rent, which was deductible to the corporation. So these deductible payments by the corporation to the shareholders eliminates, to the extent of those payments, it eliminates the tax at the corporate level. Because if you've got a $100 salary, $100 income to the corporation, $100 salary to the shareholder is deducted, it's a wash. There's no tax at the corporate level. The tax, of course, is assessed at the shareholder level. Whether it's rental, whether it's rent, whether it's salary, or whether it's bonus, it's all taxable income to the shareholder, but at least it's only taxed once. Now the corporate rates up until 86 were higher, so that income, the individual rates until 86 were higher, so the drawback was you're paying income tax at a little higher rate because the individual rates were higher, but at least you're only paying once, not twice, if you could make payments to the shareholders in some fashion that was deductible. The rest of the strategy was, as this family-owned or closely owned corporation continued business, was to the extent that those shareholders didn't need all of the income earned by the company, you left it in the corporation. Corporations' rates were, tax rates were a little bit lower. So you accumulate that money inside the corporation and you pay tax on it each year at a lower rate. If you pay, to the extent you pay money out to the shareholders, you do it on a deductible basis, so it's only taxed once at the corporate level. The money that's not distributed to the shareholders, you keep in the corporation, so it's only taxed once. That's at the corporate level, but it's at a lower rate. Then, at the end of the road, when the owners are ready to sell the business or liquidate the business, they do so in a fashion, in a sale or a liquidation that qualified for long-term capital gain treatment, so that the accumulated assets inside the corporation could be taken out by the shareholders at capital gains rates, which was at a lower rate still. Now, that was the common long-term tax planning for corporations up until 1986. In 86, you guessed it, they turned things completely upside down. In 1986, when the Tax Reform Act of 86 was passed, for the first time in the history of our country, the corporate rates were became higher than the personal rates. The highest corporate rate, income tax rate right now is 34%. The highest marginal income tax bracket for individuals is 28%. And it's a little 33% window that not everybody has to worry about, but generally speaking, the highest marginal corporate tax rate is 28%. So now the individual rates are lower than the corporate rates. That's number one. Number two, we don't have long-term capital gain treatment anymore, so that fun is all gone. Most importantly, that when you wind up a corporation, liquidate it or sell the assets, there's no more single taxation at the long-term capital gain rates. Rather, the sale gets taxed twice. Once when the corporation sells its assets, and a second time when the corporation distributes the proceeds of the sale to the shareholder, it gets taxed at the shareholder level. So there's an awful tax bite with a conventional corporation when that corporation goes out of business. So by way of conclusion about strategy, what's evolved during the 1980s and through 1990 now, 1991, is that partnerships and S corporations have become much more popular because, as you will see and as we discuss it, these are pass-through entities. The best way to describe it as for tax purposes is that these are pass-through entities. A corporation is a separate taxable entity with its own rate structure. A partnership and an S corporation, in sharp contrast, is a pass-through entity, and there is no tax at the partnership level or at the S corporation level. Rather, all items of income and deduction are passed right through to the shareholders of the S corporation or the partners of the partnership, and they're picked up at the partnership level. And in that fashion, when the business is sold at the end of its operation, the gain, I'm not going to call it capital gain because we think of capital gain rates, but the gain is taxed only once, and that's the other major advantage. So many people are in business to just try to put food on the table, take enough money out of the company to pay themselves a wage so that they can get on in life and to make their money when the business is sold at the end. And if you have a partnership or an S corporation, you avoid this double taxation at the end when the business is sold. So that's kind of the evolution of the tax planning strategy in the 1990s. As you can see, what's become very, very popular is the S corporation, because under the current tax law, the S corporation combines the advantages of limited liability under Michigan law, limited liability of the shareholders as far as their creditors are concerned, with the pass-through treatment for income tax purposes. So or any advisor sits around and advises a client, many times now in the late 80s and early 90s, the conclusion arrived at after the discussion is that the best way to go is to form an S corporation, which leads to a whole series of questions. Is the S corporation available? For a lot of reasons, it's intended to be, it's called the S now is that they put it in subchapter S of the Internal Revenue Code. For many years, the S stood for small corporation, and it's really intended to apply only to small corporations, small being a relative term. Small to people in Port Huron is a lot different than small to people who live in New York. But for most businesses and the types of businesses we're talking about here, S corporation status would be available. In order to have it, your corporation cannot have more than, and the question is S corporation status available? It's available only if there are less than 35 shareholders. One rule is that only certain types of shareholders types of entities may be shareholders. Trusts cannot be shareholders. Partnerships cannot be shareholders. Other corporations cannot be shareholders of an S corporation. Those would be ways, schemes and devices for trying to have more than 35 shareholders. You could have a trust with 20 beneficiaries, or a corporation with 20 shareholders, or a partnership with 20 partnerships. And if you plug that partnership or that corporation or that trust into the ownership of the company, you could have 30 shareholders and then a trust with 30 more shareholders. So the IRS said, no, we're not going to fool around with that. Only individuals can be shareholders of S corporations. An estate, if a person dies, you've got to get the stock of that S corporation out of that estate quickly, because an estate cannot be a shareholder of an S corporation. Only citizens of the United States can be shareholders of S corporations, which creates lots and lots of problems trying to do business in St. Clair County, because there are lots of Canadians investing in businesses over here, and that creates some serious problems to businesses which would otherwise qualify as S corporations. Those are just some other limitations. An S corporation can only have one class of stock. You can't have common stock and preferred stock. You can't have voting common stock and non-voting common stock. You can't split the ownership of the corporation from rights to its income, and it restricts substantially a lot of the fun we business planners like to have when we set up a corporation, giving the preferred stock to the older generation and the common stock to the younger generation, or vice versa. I guess your a tax planner, a business planner's life probably doesn't sound like much fun when you describe setting up different classes of stock as a way of having fun. But that's a way of having fun in business planning, but it's not available when you're setting up an S corporation. So S corporations are not available for everyone. Are they helpful? Sure can be helpful. As we've discussed, they limit your liability. If you're setting up a corporation and you're putting your assets into the corporation and money into the corporation, and you still have a home or you have investments of your own, you know that that home and those separate investments will not be responsible for the corporation's debts as long as the business is run properly and within the bounds of the law. Can it be otherwise helpful? It sure can. The most small businesses, even the ones that turn out being successful, lose money for any one of a number of reasons in the early years. Maybe it's too strong to say they lose money, but at least they're not profitable because they might have a lot of depreciation deductions, they might have a lot of startup costs, but they don't show a profit until they've been operational for at least several years. One of the advantages of the S corporation is that as a pass-through entity, it passes those losses through to the shareholders. So that if those shareholders have income from other sources, the losses from the S corporation may be used to offset the income from other sources and save those shareholders some taxes. So, so that's one of the reasons, one of the major reasons S corporations are very, very, very attractive, particularly in those early years. Those losses are limited to the shareholders' investment in the corporation. And here I'm going to talk just for a minute about one of the rules that just drives business planners nuts when they're trying to help people set their businesses up. In an S corporation, the extent to which a shareholder of an S corporation can take the losses out of the corporation or permit those losses from the corporation to pass through and to shelter income on his own income tax return, it's limited by his or her investment in the corporation. That means the money or the asset, value of the assets that person gives in exchange for his stock, and the loans, the money or the assets which that shareholder loans to the corporation. So if you have a shareholder who puts $10,000 into the corporation, and you determine that 5,000 of it is for stock, so he gets 5,000 shares back, and he gets back a $5,000 promissory note back from the corporation. He's got a $10,000 investment in the corporation, and he can take $10,000 in losses out of that S corporation and offset it against his other income. Once he gets over $10,000, he cannot take those losses any longer. But remember I said if he loans the money to the corporation. Now, if he goes to the bank and borrows $10,000 from the bank and puts that into the corporation for stock and for debt, that's fine too. That works. He's still got $10,000 investment against which losses can be offset. But if he goes to the bank and has the corporation borrow the money and guarantees that loan, remember we talked about personal guarantees, and the bank says guarantee that loan personally, and that's how they set it up, that doesn't qualify. And I've had more clients who've ended up coming to talk to us after that's happened, because the bank doesn't know and the bank doesn't care. Frankly, they think it's nice and clean to have the corporation borrow the money and then have the shareholders guarantee it personally. But that does not count under these rules as an investment in the corporation for purposes of establishing a basis for taking losses. And usually this issue doesn't come up until the corporation's first income tax return is due, at which time it's too late to do anything about it. So it's important to do this planning and do it right in the early stages. The crazy thing about it, when I say it drives business planners nuts, is that there's no real logic to that distinction, at least not that I have seen anyway, because what is the difference between the individual borrowing the money from the bank personally and signing his own name and then making a loan to the corporation, as opposed to having the corporation borrow the money and guaranteeing it personally? In either event, if it doesn't get paid, that shareholder borrower is on the hook to pay the bank back. So it should not make a difference, but it does. In any event, more than any of you ever wanted to know about about basis and taking losses from S corporations, but that is one of the advantages, is that, that your losses can pass through to you and to the shareholder and shelter your income from other sources. The other advantage, of course, is that at the time of sale with an S corporation, there's no double taxation. When the corporation sells the business assets to the buyer and incurs a substantial capital gain, there's no gain being taxed to the corporation because it's a pass-through entity. Rather, all of that gain passes through to the shareholder, and the shareholder presumably pays the debts, puts the balance of the money in his pocket, and gets taxed only once, and that's at the shareholder level. Over the years, as the business has operated, there's an interesting relationship between dividends and salary, and that relationship has to do with FICA, Social Security tax. If it's an S corporation, keep in mind that as the S corporation earns profit over the years, that profit is taxed to the shareholder as ordinary, it passes through as ordinary income. Now, the corporation may be paying that shareholder a salary, and it can pay the shareholder a salary, in which case it has a deduction for that in computing what its profit is. There's no tax at the corporate level because the profit passes through, but that salary deduction is important in arriving at the profit figure. But when that deduction is taken, or that salary is paid rather, that's subject to all payroll taxes, including but not limited to FICA and the Social Security tax, which is, I think you all know, is very, very substantial. So one game that is played, and I'm going to call it a game, is that some shareholder employees try to reduce their wages or pay no wages or just a minimal wage and let all that profit pass through to them as profit. Let the profit pass through as profit, and there's no FICA tax on the profit. And so the IRS is now in the position of, instead of in the old days where they attacked high salaries as being unreasonably high, they're now attacking many salaries as being unreasonably low, because if a shareholder employee is working for the corporation, for the S corporation, the IRS wants to protect the integrity of the Social Security tax by saying you have to pay yourself a reasonable wage, on which, of course, the FICA tax is assessed, and only the net profit then after a reasonable wage is going to pass through to you free of tax and free of the FICA tax. I should say free of the FICA tax. The rest of it passes through and is taxed at the shareholder level. But the S corporation can be used to I'm not going to say avoid FICA, but because it cannot properly be used to avoid FICA, but it can be used to minimize the cost of the Social Security tax. It's 10 to 8. Maybe what's common? Do you usually take a break and take 10 minutes, let's say, and come back at 8 o'clock, and I'll talk about partnerships. I'll talk about limited partnerships, and then a couple of other features of distinguishing between these kinds of entities when you set up a business.